So my name is Brent with MBS Financial. I'm glad to be here. This is a presentation on deferred compensation. The title, as you can see, Addressing Compensation and Benefit Challenges, Introduction to the Effective Use of Non-Qualified Deferred Compensation Plans, presented to the Chicago Compensation Association. My partner in crime here today is Eric Speed, and I'll introduce him in a second, but a little quick introduction about MBS Financial. We are solely focused on deferred compensation plans. This is our area of expertise. I would say we are a top industry leader, if not the industry leader, in deferred compensation plans. Our principals have decades of experience that go back to the 1980s on deferred comp plans, and we were founded in 2013. I personally am a consultant with the MBS Financial, and in terms of Chicago, never been there personally, but I am going to be going there in about a month, and I look forward to the presentation today. Eric, maybe say a few words about yourself so they can get to know you, and just so you get a feel for Eric and I, we're going to be tag teaming a little bit on the presentation. So I'll do some slides, Eric will do some slides, and you'll get to hear both of us here. But Eric, let's hear about yourself.
Sure. So Eric Speed, we're both based in California. I'm in Los Angeles. Bryn's about 60 miles south of me. I have about a little over 20 years of experience working with plan sponsors to help design, implement, and manage, highly valued, non-qualified deferred compensation plans for their key employees. I do have some Chicago roots. Before I moved to LA, I lived in Chicago for a couple of years, and my sister and parents still live back there. So I'm there at least once a year. So very familiar with Chicago and actually really love Chicago. So happy to be here and sharing a little bit of a content. Hopefully you find it informative in your jobs and useful, because these plans are getting very popular. So even if you don't have one now or don't work for an organization that has one now, you may at some point. So it'd be, I think, helpful to have at least an awareness of what the overall purpose of these plans are.
Great. And again, whether you have experience with non-qualified deferred compensation or not, whether you have a plan or you're working at a company that has a plan or doesn't have a plan, I think this presentation will have something for everybody. So let's dive in here. Let's see if I can move this here. Okay. Quick thank you to the sponsors of Chicago Compensation Association who help us fulfill our missions to educate, collaborate, and bring together compensation professionals from the Chicago metropolitan area: Syndio, Meridian, Willis Towers Watson. I'm certainly familiar with putting on events, presentations, webinars, and I know a lot of times these things do not happen at all without sponsors. So we definitely appreciate them today. Here's a quick agenda of what the breakdown is going to be of the presentation. We'll get into all about non-qualified deferred compensation plans. Now, I know that's kind of a mouthful to say. We're just going to refer to it mostly from here on out as deferred compensation plans, or DCPs. You might know it as non-qual for short, but again, a deferred compensation plan, DCP, is what we're talking about today. We'll get into, what are they? Some reasons that companies would offer them, the basic rules that govern deferred compensation plans, the benefits to the plan sponsors, the reasons, advantages of why a plan sponsor or company would implement or offer a DCP. What are the benefits to the eligible employees? Certainly very valuable and important there. We'll talk about some best-in-class design elements. Then Eric will also speak to some current market developments as they may directly or indirectly impact your DCP plan or DCP plan, such as inflation, Secure 2.0, and a proposed non-compete ban. We'll kind of finish the presentation today with some case studies that Eric will talk about, and of course some Q&A. But of course, we want to keep things somewhat informal. So if you have a question, please raise your hand or chime into the box. Maybe somebody can help monitor that in case I don't see it, and we'll address those questions as they come in. So don't hesitate to ask a question as we go along here. And we'll also talk about at the end kind of more about MBS and how we fit into the mix here in terms of deferred compensation plans. And Eric, I'll hand it off to you to tackle this slide.
Sure. So non-qualified deferred compensation plan, or deferred compensation plan for short, as Bryn said, You may heard it referred to as non-qualified plans. Don't let that scare you. Non-qualified is nothing extraordinarily complicated. It just means it's not a qualified plan, which is like your 401k or your pension plan, in short. But what is it overall? Well, it's an employer-sponsored benefit, number one, that it can be provided at low cost to employees, or even no cost, that is highly valued by those employees. It is available to select key employees to defer as much of their compensation, whether it be cash or equity, as they want to on a pre-tax basis. So very much similar in that respect to a 401k plan, except there's no limit to how much they can set aside on a pre-tax savings basis. And they can defer that compensation for as long as they want to. Bryn will get into some of the design elements in terms of when a triggering distribution event can occur. But that's a question of how you want to craft the plan from a design standpoint. So they can defer it, and they make an election as to when and how they want it paid back to them. So that's their election. So that's the basic form of it, but it's also a platform that allows you as plan sponsors to make individualized, discretionary company contributions to select employees. That's one of the benefits of not being a qualified plan, is that you can be very specific in terms of who you make contributions to. And that's helpful in recruiting employees, rewarding employees you already have, or incentivizing or retaining those existing employees. So just a recap, it's a pre-tax savings and wealth accumulation vehicle that has no limit, and it gives you the ability to make company contributions customized to the individual. That's essentially what a deferred compensation plan is. We'll talk about more of the rules governing it and some best-in-class design elements and some case studies, but that's sort of the main elements of a deferred compensation plan.
Great, thank you, Eric. So what are some of the top 3 reasons for offering a DCP? This actually was a survey that the PSEA did of non-qualified deferred compensation plans in 2021. And these are the top 3 reasons given from the plan sponsors of why they're offering a DCP. Number one, the biggest reason, 94% of the time, they said to have a competitive compensation and benefits package. I mean, that is big. You want to make sure you are competing or being competitive when it comes to your peers in today's market, especially in a tight labor market or a shrinking workforce. Having competitive benefits is essential. You can almost, can you afford not to have a deferred comp plan in today's market? Think of it, I kind of bring things down to sports a lot. I mean, this is a Chicago area compensation. So Chicago Bears want to be competitive in recruiting and bringing in the best players to their organization, to their team. So they could say something like, you know, we have the best coaching staff, we have the best general manager, like our training facility is amazing, where we play, our field is great. All these things. Similarly, a company would like to go out to the market and say, we have good PTO policies, we have a good 401k plan, we have good insurance benefits, we have a deferred compensation plan. It makes them competitive out there compared to their peers when it comes to bringing in talent. Number 2, asset accumulation, 6-7%. That kind of speaks for itself. This is a tax-efficient wealth accumulation vehicle for your company. And number 3, employee retention, 59% gave this reason, the 3rd most popular reason given. And kind of on the flip side to recruiting, you also want to retain that talent you have at your company, retain those big quarterbacks you have, those key employees, those top paid players that really make your company or your team go. Keep the talent you have so that they are not wooed away. And a deferred compensation plan can be used to do that. And we'll also kind of dive into that a little bit further as well in the presentation. A quick chart here, a little visual, pretty simple, is why 401ks are not enough for HCEs, another HCEs, highly compensated executives or employees, in other words, key employees. Why 401ks are not enough. As you can see here, it's a general graph. As compensation increases, an employee's deferrable percent of income decreases. Now, these plans, deferred compensation plans, came about in the 1980s as a result of the limits imposed on 401k plans. And just a reference, we'll probably bring up 401k plans a lot. We're not here to bash on 401ks, but we all are familiar with them pretty much. So it's a good reference point between 401k and a deferred comp plan. I love my 401k, but you'll see the differences as we bring up 401ks to compare to deferred comp plans throughout the presentation. And what this graph or chart is saying, it's a graph, I guess, is that the more you make, the less you can put or defer into your 401k plan. Take somebody here who makes $100,000 in a year, they can put or defer 23% of their income into a 401k plan. But the more you make, you slide over to somebody who makes $200,000, they can only defer 11% of their compensation into a 401k plan. The actual dollar limit this year is $22,500. That's a maximum you can put in a 401k plan at a company. Now, if you're over age 50, they do allow you to go up to $30,000 in those cases. And one last point here, MBS, we actually are very close with all of the deferred comp plan record keepers and providers in the space. We meet with them on a quarterly basis. We know them very well. We actually survey them on a yearly basis. And what we found in our recent survey is that over 11,600 companies offer a NQ DCP or deferred compensation plan. I know that's just a number, 11,000, but that basically what that means is, and you'll see if you want a copy of the survey, email me, be happy to give it to you to give you some more illustration there. But what the survey is saying is that deferred compensation plans are trending upwards. They're on the rise, becoming more popular. So deferred comp plans and people who are participating, enrolling in plans is also increasing as well. Again, you can email me if you want a copy of that survey. I'd be happy to provide it for you. All right, let's talk about some of the nuts and bolts of a deferred comp plan. Now, it was codified in 2005 with IRC section code 409A. So again, this is not a 401k, it's a 409A. So we might also refer to a DCP as a 409A. That's the tax code associated with deferred comp plan. And we'll talk about eligibility. Who can be or who can participate in a deferred compensation plan? Now, as 401k is generally a basic benefit, more designed for the masses, a 409A deferred comp plan is designed to layer on top of that, specifically for those people that are negatively impacted by the limits on a 401k. And in terms of eligibility, all the 409A code says is that it must be a select group of management or highly paid employees. That's it. That's the entirety of the guidance. But all that basically means is it has to be a select group of people. It cannot be for everybody like a 401k plan. As a general rule of thumb, I'd say as an organization or a company, rather, you're looking at about 5, maybe 10% of your U.S. employees that are going to be eligible for a deferred comp plan. Now, if you're a much larger company, talking about thousands and thousands of employees, huge companies, that percentage will decrease, of course. But the big takeaway here is that it's a limited plan in terms of who can participate. It's not broad-based. Moving down the slide here, deferrals are pre-tax from federal and state income. They're tax deferred, and there are no maximums. So those are some big points in terms of what a deferred comp plan is. So there is no cap. You can defer as much as you want into your deferred comp plan, and it's all pre-tax. So think of it as, a senior, if you have a senior executive or a highly paid key employee, this is a fundamental benefit of a deferred comp plan. They are not limited as far as how much they want to defer. Theoretically, they could put all of their salary, all of their bonus. We'll dig into those details a little bit about the compensation types. But theoretically, they could put all of that in a deferred comp plan with no maximum and invest that pre-tax, which is a big deal as well. So it gives them the ability to manage the taxation of their compensation. In terms of distributions, they're permitted on separation from service and a specified date. Now, separation from service could be like a 401k, could be based on retirement whenever you separate from your service, your company, but doesn't have to be. Could be when you change companies. Maybe you're just going from one company A to company B in 5 years. That can be a triggering event for a distribution to be paid back to you. Another big one in terms of distribution options that is not, that you don't see in a 401k plan, that's a fundamental part of the 409A plan, is specified date. So you can choose any specified date essentially to have this money paid back to you. Could be 2 years from now, could be 10 years from now, it could be 20, 30 years from now, could be, if you want to make it more towards a retirement vehicle, you can. But the specified date allows you to have distributions, to have these savings paid back to you at a time that you want. An example could be college education. I have a 3-year-old and a 5-year-old son, boys that drive me crazy. Hopefully they maybe get a full ride scholarship somewhere, but never know. So this could be a way for me to save for their college education. I could pick a date, let's say 2037, and have that be a specified date in my plan that I want money to start being paid back to me over 5 years. So I have that vehicle, those pre-tax dollars being invested and saved and paid back to me when my 5-year-old goes to college. It's a way to save for his education. So that's a big one there. Moving on, it's exempt from most ERISA requirements. It can identify individual employees or groups of employees for eligibility or discretionary company contributions. What that basically means is that there is no discrimination testing. There's no 5500 reporting. In fact, all that's required really is a single top hat filing, that's done within 120 days of starting the plan. So this allows a lot of flexibility within the design of a deferred compensation plan and DCP. You can pick, as we talked about, certain or select employees, not only for eligibility, but for discretionary company contributions. So you can use this, you can handpick, I want that group of employees to be eligible for a contribution or a bonus, what have you, that you might have at your company, and put it in their deferred comp plan. You don't have to offer it to everybody. Maybe you're bringing in an employee, as we talked about the previous slide, to recruit an employee. You can pick that employee or that recruit and put a contribution specific to them into the plan. On the other side, you're trying to retain an employee. You can put a contribution specific to that employee in the plan, in the deferred compensation plan. And this gives it the flexibility and the fundamental design elements in order to do some things like recruiting, retention within your company. Last bullet here, the compensation deferred remains a company asset until distributed. What that basically means is that until that balance is paid, the employee is essentially a general creditor to the company. So that money that goes into the deferred comp plan is not paid back to you yet, but it eventually will be. But until that is paid, the employee is a creditor to the company. So there is a risk of forfeiture, but we do have ways to secure the benefits, to secure those funds against any situation. So there are ways to mitigate and manage that. And last thing I'll say here is that think of it also as a form of stock, what have you, for your key employees. Those are in the plan. They have money invested in the plan to be paid back from the future date. They are the ones driving the success, oftentimes the profits at your company. So they're going to be invested in the future of the company. They want your company to succeed, to have longevity, to be able to pay back to them the money that's in the plan. So in a way, it benefits them, it benefits the company when your key employees are already participating, deferring, and already investing in a deferred comp plan. So what this boils down to, basically, I know we kind of covered a lot of bullet points here, but basically the takeaway here is a deferred comp plan is about selecting key employees, talking about how much do those key employees want to defer, where do they want to invest it, touch on that a little bit, and when do they want to pay back. Again, key employees, how much to defer, where do they want it invested, and when do they want it paid back. Okay, moving on. So let's talk about more specifically here the benefits to the plan sponsor, the company. Why would a company have a plan that benefits to them, the advantages of having a plan? It's a competitive benefit offering. It enhances the value of your existing compensation strategy without increasing cash outlay. Provides HR another tool in the toolkit to attract and retain key talent with sign-on bonuses, known as the golden carrot, and also targeted retention bonuses, known as the golden handcuffs. So basically, it gives you the ability to do more with your existing compensation without necessarily increasing the amount of compensation you're already paying out. What a great tool for the HR department, the rewards department, compensation department to do more with what you already have. Okay, so similar to a 401k, it provides also a vehicle to increase the value of compensation by deferring it on a pre-tax basis. Again, pre-tax basis, do more with what you have. Make the process of hiring, retaining, even retiring your employees enhanced with a deferred compensation plan. And also, this is bottom line, it's a low cost, easy plan that will not affect your budget. A lot of times a DCP plan, a 409A plan is self-funding. A lot of times they can be implemented with no fees at all. So it's low cost, it's easy to implement, and this is something that you in your quiver, a tool in your toolkit, an arrow, what have you, a tool to help you retain, recruit, reward employees. That's kind of the 3 R's you refer to a lot as well. Okay. And benefits to the eligible employee. Why would an employee want to be involved in this? So it allows the eligible employees, the key employees, to control when and how they take taxable receipt of their compensation. That's a big one right there. I mean, that can't be understated. I mean, having the ability to take control of when you have taxable receipt of your compensation is big, especially for those high earners. I mean, if you could defer, let's say you have almost using a basic example here, a CEO that makes $500,000 in a year, but he only spends $300,000. So that $200,000, he can invest it pre-tax and save it in his deferred comp plan. That's amazing. You can't do that in a 401k plan. All right, so that's a big benefit. Okay, and it provides all the benefits of pre-tax investment without dollar caps. We talked about that. And the company match element as well. Now, for those highly paid executives, those key employees, they will run into matching limits with a 401k plan. So those can actually be made whole or made up for in a deferred compensation plan. So that's big as well. All right. So again, would you rather invest as an employee, and not even an employee, would you rather invest as average Joe, a whole dollar or a partial dollar? Again, that would carry over to someone who makes a lot of money. You want to invest a whole dollar or a partial dollar. Pre-tax investing is big. Okay. And the matching element as well, which we'll talk about. All right. This slide talks about some of the best in class design elements of a DCP plan. Now, you want to make sure they're simplified, streamlined, and easy to understand. A 401 plan, which can be better. These are very customized for each company. So working with a consultant, a firm like MBS Financial, is key to make sure that the customization of your plan fits your company the right way, and also can be easy to understand for your HR department, for your executives, for the enrollees of the plan as well. So we help you make it streamlined, simplified, easy to understand, and then make sure it accomplishes what you're trying to do at your company. For deferrals, use the major forms of compensation already used by your company. So if you do use salary, bonus, commissions, put those also as elements to be eligible to be deferred in your deferred comp plan. Some companies use RSUs, restricted stock units. You want to design the plan to permit those, whether or not you actually whether or not those are actually activated in the plan or used in the plan is one thing, but make sure they're able to be, the design is such a way they can be used in deferred comp plan. Restoration of matching contributions restricted in 401k. Similar to a 401k, you want to try to have a matching element in your deferred comp plan, your DCP plan. It's not required, but we see in our experience that when you have a matching element in your 409A DCP plan, just like you do in a 401k plan, you do see an increase in enrollment. So a lot of clients, a lot of plans do have a matching element in their 409A plan, and it's a restoration element in terms of what they can't match in a 401k. Again, there are limits. If somebody makes a lot of money, the company cannot, they're kind of blocked and limited in how much they can match in their 401k plan. Well, that amount can be made whole or restored in a 409A deferred comp plan. So it's a big element as well. We do recommend having a match if you can. A diverse array of investment choices, including asset allocation and fixed crediting, similar to a 401k plan. You're going to see typically between 12 to 18 funds, just like a 401k plan, in a deferred comp plan, a diverse array of investment choices. It might be a little bit different in terms of some of the menus and the funds in terms of the deferred comp plan compared to the 401k, because again, a 401k is more geared towards retirement. Your 409A deferred comp plan may not necessarily be a retirement vehicle. So some of the funds could differ as far as that go. But generally, again, the same 12 to 18 funds are going to be in both. Okay. Distribution upon, let's talk about some of the triggering events to distribution for your deferred comp plan. Termination, that can be when you decide to leave the company. So that could be, again, retirement or termination from the company where you're leaving a company, going from company A to company B. That could be a triggering event to have your deferred comp balance paid back to you. It can be a specified date. We talked about that as well. In fact, I brought up the example of college education savings. We've actually, our firm has done an actual article in the Deferred Compensation Journal about comparing 409A deferred comp to that 529 college savings plan. So if you want to copy that article, let me know. But again, college savings can be used for that. Could be a specified date. It doesn't have to be college savings. Could be something else. A date in the future, maybe where your tax bracket is lower. You want it paid back to you then, to take advantage of a different tax bracket in the future. Change of control. So if the company you work for is sold, merged, acquired, different leadership comes on board, that can be a triggering event. So that would trigger your deferred comp plan balance to be paid back to you in that situation. That's a common one. Two that actually are not on this slide are death. Of course, if you die, don't want to bring about that and be too morbid here, but that would be a triggering event, and your deferred comp balance will be paid back to your beneficiary. Another option here that you'll see, very rare though, is disability and hardship. That can be used as a way to get the payment back on your deferred comp plan, but pretty rare on that one. Distribution methods. So lump sum and annual installments are the big two here. So you can have your deferred comp plan paid back to you on one of the triggering events in a lump sum. A reason for doing that is that maybe you just want all that money paid back to you and you're done. You kind of wash your hands. You got your money. Now you can move on to the next part of your life or next company you're at. But sometimes annual installments are popular as well, because a lump sum could create a triggering event in terms of taxes, a tax bracket event, or a bigger taxation year if you have a lump sum coming in altogether. So annual installments, usually 2 to 10, 2 to 15 years, are selected as well as far as distribution when that money comes back to you in your pocket from a deferred comp plan. To secure the rabbi trust, we talked about ways to protect the funds. This is what that is. It's a rabbi trust. It's a vehicle to help protect those funds for you while they're deferred and while they're being invested for you, pre-tax. Again, big bullets at the end here. Deferrals are used to self-fund with no additional outlay from the company. So all of the money that's being deferred from your employees year after year, that is the funding for the deferred comp plan. So you don't have to put in extra cash from the company to make this plan work, to make this plan go. Okay, and it's a low cost to the plan sponsor. So if it doesn't cost any money and it's low cost, why not implement a deferred comp plan for your company? Okay, I'll pause quickly here before I hand it over to Eric for some market developments. Any questions? I know I've kind of ran off a lot of information, want to slow down. Any questions so far?
There aren't any in the chat as of yet. We can keep watching, but we can. Oh, actually, there is one that Chris just posted. Can you talk more about the Rabbi Trust?
Sure. Eric,
Yeah.
you want to jump in and talk about that a little bit?
Sure, I can field that one. So a rabbi trust is a grantor trust, which simply means the plan sponsor is the granting company, and it's accounted for. Any of the assets in the trust are accounted for on the books of the company, of the plan sponsor. They can be irrevocable or revocable, but what it does is it segregates the assets that are funding this plan from the general assets of the company. And so absent sort of a bankruptcy situation, that restricts the use of those funds to the payment of participants' benefit. So that's the main advantage of a rabbi trust, simply called a rabbi trust because it was the very first one was done for a rabbi of a synagogue, but that's the benefit it provides the employees. They know that the money is set aside, that it's not an unfunded obligation, and that there are assets there that are would be available for use when their time comes for them to receive the distribution from the plan.
Thank you, Eric. It looks like Dave has his hand up.
Yeah, hey, thank you. Hey, and you may have touched on this earlier, so I just got distracted for a little bit and came back. But I'm looking at the third bullet that you have, restoration of matching contributions, right? And when you think about deferred comp, I think about the restoration piece. I think about bonuses being able to go in, or a percentage of bonuses or in full going into a deferred comp plan. Also just in terms of percentage of salary. And I guess my question is, do most companies, and maybe there's a regulation that drives the answer what I'm about to ask, but do most companies have one deferred comp plan, non-qualified deferred comp plan that allows those different entry points, right? Restoration, part of your bonus, part of your salary, or do most companies kind of have separate plans for those funneling of money into the plan for those different kind of election points?
Right.
What do you see?
Historically, there was a pour-over plan or a restoration plan, which you sort of described, used to be kind of its own thing. But the last 15 years or so, they're basically all new plans are all on a single platform. So they may have a 401k refund element, their salary, their bonus, they're all tracked separately by the record keeper, those sources of compensation. And they may be able to permit, generally they do, different elections, whether or not somebody wants to defer any or a portion of that type of compensation. But they're generally all record kept within the same platform and within the same plan or plan document. So I don't see them, certainly not any new design necessarily created separately.
And if you have it in one plan, can you make it such that the restoration aspect of that plan, the restoration feature is automatic, or would an employee still have to elect for the restoration feature?
It can be either way. Generally, we see them as elections. So if somebody doesn't choose to defer their compensation, they're not getting any of that restoration match. I have seen generally where I see it sort of non-elective is more in sort of a pension equivalent. Like if they close down the pension plan, they may get sort of a service-based company contribution or something along that line that can pour over into the deferred compensation plan if they're due to the scrim test or what have you, it's automatic. But generally, if it's like a matching of employee deferrals, that's usually associated with a voluntary election by that individual to defer some portion of their compensation.
Thank you.
Okay.
Eric and Bryn, there are a couple more questions, but I also know you had a couple more slides to run through. Should we take questions first, or do you?
Yeah, let me, I have the chat questions up here.
Okay.
Let me see if I can quickly, so there was a question on deferral of equity versus cash payout and how that works. It's a little bit beyond the scope of this discussion. I'd be happy to engage in a conversation on that. Basically, it has to do when you're looking at when it's granted and when it's vested, there's a period of time that a participant can make an election to defer that. But that's generally associated with restricted stock units. But we see that quite commonly in these type of plans. And then there was a follow-up question on in the event of an employer who filed for bankruptcy, how is determined where employees with DCP stand in line compared to other creditors? That's a good question. So a little bit of context on the bankruptcy question. So two types of bankruptcy, Chapter 7, Chapter 11. Generally, the existence of a rabbi trust is beneficial in both cases. It's not determinative in either case. A lot is up to the bankruptcy court judge's discretion. But in a Chapter 11 filing, the company intends to exist after bankruptcy. So the existence of a deferred compensation plan with a rabbi trust generally does not get a detrimental effect on that trust. They usually don't touch that because the company is going to exist after the fact. Where the real risk of forfeiture comes in, and to this individual's question, is to where me as a participant or you as a participant stand in line of creditors, in the event of bankruptcy, is the Chapter 7 form of bankruptcy, where it's the so to speak, the going out of business sale, where they're selling the computer desk and everything they can in terms of a corporate asset to satisfy creditors. Again, there's no hard and fast rule. Generally, the existence of a trust is beneficial, but it does not insure against loss. It could be the bankruptcy court's judge discretion as to where that individual stands in line of creditors. There are some nuances to the language of the rabbi trust that can be put in place to sort of try and attempt to identify where in line. I can say sometimes it's occurred that at least the principal that goes in is deemed wages. Wages typically move to the front of the line of the creditors, but the investment earnings are not. So there's not a short answer, and I realize I just gave you a long one. There's not a short answer to that question, nor is there a uniform rule on that is the main takeaway. And there's a last question that I see: is there government agencies participate in this type of deferred compensation plan? Not specifically. So a 409A plan is designed for for-profit companies, C Corps, LLCs, what have you. There are sort of equivalents in the government and not-for-profit space that are sort of beyond the scope of this discussion again. And we don't deal directly with those. They're 457 or 403s that are similar in sort of the deferral of compensation element, but there are different rules on those. So these that we're reviewing are specifically for the corporate marketplace. Okay, and I just want to do a quick time check with Gia. We have to the top of the hour, is that correct?
Yes, so 10 more minutes about.
Okay, all right, well, I'll speak quickly or I'll edit as we go. Bryn, if you want to click on, so a couple of marketplace developments. Inflation. It's been a buzzword for the last year. When it was last summer, it was up over 9%. It has come down. People ask, what can a deferred comp do to combat inflation? And there's nothing really directly that it can do. And people are concerned that inflation is eating away at their retirement savings and the ability, the purchasing power of their savings. So you can either work longer, you can earn more money, you can spend less in retirement, or you can save more. And that's where a deferred comp plan comes in, because it does give those that are eligible the ability to save a substantial amount of their current compensation for a future date. Secure 2.0. I'm sure many of you on this call are very familiar with this. There's lots of different aspects that impact retirement plans, particularly 401ks. There's nothing that in that directly impacted non-qualified deferred compensation plans, but there was a provision that applied to 401k that sort of indirectly impacts deferred compensation plans, and that is the catch-up contributions. Catch-up contributions are currently $7,500 that employees over age 50 can make into their 401k plans. Starting next year, the IRS is requiring those for anyone over 145,000 in earnings to be raw, to be after tax. So for that group of segments of employees, it's basically a 25% cut in the amount that they can save on a pre-tax basis, going from 30 to 22.5. So just something to be aware of when you're communicating your 401k plan. There's been some articles in the Wall Street Journal of late. One of the things MBS does is we keep our thumb on regulatory and legislative developments, and we alerted our clients to this little nuance in the Secure 2.0 back in January so that they had some time to prep for it. But you certainly want to communicate that, make your employees that are subject to that restriction aware of it. And maybe that might prompt somebody to say, you know what, I want to switch at least that 7,500 to my deferred comp plan, or you as a plan sponsor, if you don't have one, may impact your evaluation of whether or not you want to have one given this new restriction. And the final sort of marketplace development is a proposal by the Federal Trade Commission to ban non-competes altogether. Many states, including California, already ban it. But the takeaway here is, if the ban goes in effect, and that's not a given, the comment period is over, but there's been no publication of that new rule, is that you can't, as a company, can't prevent somebody to go work for another organization, but you might see greater use of deferred compensation plans because they're able to put some teeth into that activity. So, in other words, if an employee who goes to work for a competitor might forfeit a portion of their company match, for example, in their deferred compensation plan if they're found to be in violation of their, non-compete, even though a non-compete wouldn't be permitted going forward. You can't stop them from doing that, but it doesn't mean there isn't financial consequences for doing that. So that's just something to keep in mind as things develop here. So we have 3 case studies here. In the interest of time, I'm just going to focus on the second 2, if you would skip this one here. So the first is a fast casual restaurant company that we worked with. Their 401k was not safe harbor. So they had a lot of lower paid employees that, as a result of having that many lower paid employees, they failed their discrimination testing. And so they had to process refunds to their key employees, their highly compensated employees, to such an extent that it basically cut it back to about $1,000 or $1,500 is all they could contribute, their key executives, into their 401k, basically making the 401k of not of significant value to them. So they were evaluating a couple of options. One is going safe harbor, which has a cost to it with the automatic and matching components to it. Or what we worked with them to do is to design a deferred compensation plan that mirrored sort of the matching formula in the 401k. And what they decided to do was basically carve out those highly compensated employees and say, if you want to participate in a pre-tax savings vehicle, must do so in the deferred compensation plan. That way it left only non-highly compensated employees in the 401k plan, and they had no problem, therefore, passing their discrimination test. So just a somewhat creative way of using a deferred compensation plan that isn't typically thought of. If you are safe harbor, then this wouldn't be an issue. And the final case study here is, and I'll focus on the first one. They're both sort of similar. In both cases, our client found themselves challenged because they were not able to recruit an employee that they wanted to recruit, that they were at a compensation disadvantage. The first is, the executive was in a tech company that had sizable unvested options, and our client was a foreign-owned company that did not have equity available at the time. And they were saying, how can we get this employee, make them whole for what they're losing at the company they're walking away from. And what they chose to do is use the discretionary company contribution provision that should be in any good, well-designed deferred compensation plan to make a company contribution into the deferred compensation plan, and tied to it a vesting schedule that mirrored sort of the vesting of that of the options that individual was walking away from. So they weren't entitled to it on day one like a signing bonus. They had to stay for a period of time in order to vest in that company contribution, but the amount of which was made them whole for what they walked away from. And there's lots of different examples of that where you can use that discretionary company contribution to incentivize an employee or group of employees, or to offset some other competitive compensation disadvantage. So those are two elements, again, where you're using the platform of the non-qualified deferred compensation plan to make company contributions to either recruit, retain, or incentivize specific employees. And the fact that it's non-qualified gives you the ability to do that. So in our remaining minute or two, just again, an overview of us. This is all we do is non-qualified deferred compensation plans. How they're designed, how they're financed, how they're structured, how they're administered. We find, as Bryn mentioned, we work with all the record keepers in this space. Some are the 401k providers, some are custom, just work on non-qualified plans, and so we know the benefits and disadvantages of each and what might fit with you. And we also work with your key employees to make sure that they understand what this plan is all about, how they can utilize it as they want for their specific financial circumstances. And some of our services that we offer are listed there on the right. You can contact either one of us, Bryn or myself. If you have a plan, we can help you audit it, benchmark it against market to see how competitive it is. Sometimes these plans have not changed in 15 years, and maybe they're not meeting the needs of your employee base as they once were. There's different ways to review the funding, and as I said, we're very familiar with the marketplace. So if you're looking for a record keeper, we're very low cost and fast way to find the right partner for you in that realm. Same thing on the trust side. So I don't know if there are any questions. Let's see.
Don't see anything new in the chat. Any question? Final, got a minute or two if anyone wants to unmute their line.
Any final questions? Speak now. You can always reach out to Eric or myself if you think of a question afterwards, of course. But obviously, while we're here, be happy to address that for you. Our contact information is on this presentation, and we're happy to be of service to you. And again, thank you so much to the CCA for having us, and we hope this was very insightful for you, and hope to speak to you guys again in the future. If any questions, let us know. We thank you for the time today.
Yeah, thank you, everybody. We will send over this presentation to you via email, probably later today, along with a survey. But thank you so much to Bryn and Eric. Very great insights. I love the discussion in the middle, as well as those case studies. So thank you for thank you for joining us, guys. I hope you have a good rest of the day.
Thank you all.
Take care, everybody.
All right. Goodbye.